Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about IDVO. This is not to be confused with its sister fund, which if you switch these letters around, you get DIVO. I've reviewed that one before, and I'll link it up above. But by putting that I out in the front, we can get the international version, or as I like to call it, the worldwide version. We should call it Prestige Worldwide Income ETF. That would be perfect. So this thing is going to give you international exposure. It is going to offer you some dividends. It's also going to offer you some option income. So if you like that monthly style ETF, this might be a good one for you, especially if you need that international worldwide exposure. So anyway, we're going to take a look at it. If that is what you're looking for, please stick around. Whoop.
Drinking sangria, nachos, lemon heads,
my dad's boat. You won't go down because
my dick can float.
Yeah, just like my idols there, Dale and Brennan. Maybe it is time to go worldwide. You know, I saw Warren Buffett, and he's raising his stake in some Japanese stocks. Seems like everybody's looking outside the U.S. at the moment. I know personally, I've been adding slowly to my international ETFs, trying to raise the stakes a little bit. So I guess I'm a little bit like Warren Buffett, or at least somewhere between Warren and Warren Franklin Beans Jensen, right? Is that my baseball? So IDVO is very similar to DIVO. They buy a basket of stocks and they sell covered calls selectively against those different positions. But with IDVO, they focus on buying ADRs. And ADRs are simply American Depository Receipts. No, it sounds a little scary. It's not a standard stock, but yet it is a standard stock. So all American Depository Receipts do, or ADRs, is allow foreign companies a mechanism to trade shares on the U.S. market. So think about stocks like Taiwan Semiconductor, Toyota, or Alibaba. Those might be some that you've heard of before, but there's a lot of them. But they focus on large cap ADRs. So there is a small amount of additional risk, I would say, with an ADR, but since this fund is so diverse across so many countries, I personally would not have an issue investing due to the ADRs. But here's kind of that risk laid out. This is actually a little snapshot from Fidelity that I found. Thought I'd share with you. But in general, they're using ADRs. They're buying these on the U.S. market on a global fund. Now, I personally only own one ADR directly myself, and that is Alibaba, BABA. Now, I bought that at the very top of the market, so it's been less than a stellar investment for myself. I rode it all the way to the bottom. I sold some along the way, but I still have 200 shares at a significant loss. So for me, when it comes to international stocks, I prefer to use ETFs as my mechanism for investment. So I have several, and I think that's the best way for me to go. I'll focus on my individual stocks in the U.S. market, or if I find something that I really want to dig into, I will, but I think it's a great way to use ETFs when it comes to international exposure. So for me, let's see, this side, yeah, we'll put it over here. I've got VGK, that's just Europe, that's a good one. VWO, that's emerging markets. CNYA for China, and I don't put too much into that at the moment. There's lots of tensions with China, so I'm kind of holding off on that one. And then VXUS, which is very general. That's just a total international stock index with nearly 8,000 holdings. So that's a very simple way to invest internationally. Now I'm looking at adding some income through IDVO, so that would be number 5. So now let's jump over to the Amplify ETF website and take a look at IDVO, the Amplify International Enhanced Dividend Income ETF, which we know we've changed because we're in charge of marketing, so we're going to call it the Prestige Worldwide Enhanced Dividend Income ETF, but whatever. Anyway, this is brand new, 9/8 of 2022. It only has 77 holdings hand selected, and it's got a 0.65% expense ratio. So that's pretty expensive for an ETF. That means 65 basis points or $65 per $10,000 you invest is going to go to that expense ratio annually. So that's pretty steep, but that's because it is professionally managed. So it's important to understand that with this type of ETF, you've got a group behind there that is selecting these stocks in this portfolio, and then they're selectively selling covered calls against certain positions throughout the course of the year to generate income for you. So you want intelligence behind that, and always bring up QYLD and that kind of thing where that's not the case. So here I feel like you're getting something for your money. Now we can scroll down here and we're going to see the yield monthly, pays every single month. And right now it's right around 5.86%. We'll take a look at that here a little bit more as we break things down. Kind of see the chart. I know I'm going through this fairly quickly, but we'll jump down to the bottom here. And we're going to take a look at fund holdings as well. So we'll view all holdings here in a second. Let's keep going. IDVO selection methodology. And this is the important part, right? So they're looking for dividend growers, identifying ADRs of high quality large cap companies. And that's what they're basing this around. And they're looking at sector allocation, which we'll look at down here below. And then security selection, and then this tactical covered call strategy. So when they say tactical covered call, writing on individual securities, trying to lower risk and enhance our total return. So real clearly here they say fund seeks to provide gross income of about 3 to 4% from dividend income, all those different ADRs that they have in here that pay dividends, and then 2 to 4% from sold call options. So combine those two numbers and we get somewhere between 5 and 8% that they're trying to pay out every single year. And the security selection is very important. Again, we're paying 65 basis points to have someone hand select and screen these ADRs. So they're looking at things such as earnings, cash flow, return on equity, market capitalization, and management track. That makes me feel good about how I'm spending my money for this particular ETF. Something else that I like about this particular fund is just how broadly diverse it is. You can see the country allocation here. So 17% in the UK, 9% in Mexico, 8% in Taiwan, so forth and so on. If we reel around here, we get 5% in China. If there is a problem with ADRs in the future, this broad allocation is a nice benefit to us. So we're not too exposed to any one country or to any one sector as well. So you can see that's pretty broad as well, with 17% in energy, materials, IT, financials, and healthcare kind of round out the top 5 there. So pretty broad sector allocation, pretty broad country allocation. Again, that's a nice benefit for us. So now let's jump over and take a look at the IDVO Holdings. And some of these you'll be familiar with, and other ones you probably have never heard of. Even their largest one here at 4.18%. I'm sure some people will say, oh, Coca-Cola, I recognize that, but this is the bottler, the ADR out of South America somewhere. So I haven't done any research, and that's why I'm willing to pay 65 basis points to Amplify ETFs to do all this research and determine what is supposed to be in this ETF and what shouldn't. Now, some of them I do know. ABB, for example, I think I interviewed there out of college, Rio Tinto, Unilever, Shell, and a few of these other ones as well. And you can see pretty broadly diversified, and that looks pretty darn good to me. And as we scroll down, you're going to see it goes from about 1% down to 0%, and this is where we start our covered calls. So there's a couple down here and we can take a look at them. So this first one here is a covered call on Rio Tinto. This is a call option, 4/23 expiration, so that's next week at an $80 strike price. And if I jump over and look at Rio Tinto real quick, I see it's at 68 with that $80 strike price. This is going to expire worthless. They're going to be able to keep all that money, or they can close it out right now and keep all that money, I'm sure, no problem. So that's Rio Tinto, right? And that's how they're generating that income, by selling these call options. If I scroll down a little bit more, I'll find, let's see, here's ABB. Again, they've got 30 contracts here. Call option, 4/23, same expiration next week at a $35 strike price. If we look at ABB currently, we're going to see that's at $35.14. So it's 14 cents in the money. So this one might be a little bit of a loser in the end, or they might make a little bit of money. Depends on how this week goes. But you win some, you lose some, but overall it should be able to generate some income if they're making the right decisions and when they sell these covered calls. So that's the magic in what they're doing. And again, the reason why behind this, we're paying 65 basis points, and we should be able to justify and say, if we like this type of product, that we're willing to pay those 65 basis points. And finally, let's jump over to Seeking Alpha. This is a website that I use all the time for my own personal research, and I am an affiliate. There are affiliate links down below if you like what you see. But anyway, we don't even have a full 1-year chart yet, and you can kind of see that expense ratio and that yield. The yield is misleading on this particular page because we don't even have a full year's worth of data yet, so it hasn't put all that in there, so it's just basing on the dividends that have been paid out so far. But we can look at the last 6 months and at least see how it's done so far. So this is a chart showing the price return, and I'm comparing it to the S&P 500, DIVO, that sister ETF, and the Qs, QQQ. So IDVO is in orange, doing okay. The S&P over the last 6 months, okay. DIVO bringing up the rear, and QQQ at 22%. But again, that is the price return. So if we actually include those dividends, not compounded, but just include those dividends, we call it the total return. You can see that actually IDVO over the last 6 months has beat all 3 of them. So it's actually been performing pretty well. International stocks in general have done pretty well out of certain countries. So looking pretty good after the first 6 months. That doesn't tell us a whole lot, but at least it gives us some information about performance during this last 6-month period. Now, as far as taxes and ADRs go, it's best to go see your tax pro. But if you had a gun to my head and said, you have to tell me what your opinion is right now, Dave, I'd say, well, those ADRs will become qualified just like a standard dividend that you would receive from a U.S. company over time. So you'll get those qualified dividends. It'll be just like DIVO. However, you'll also pay some foreign taxes before you receive these. You won't get to see those. But you'll get credit for that later on at Fidelity. You'll see foreign taxes paid on your behalf, and you'll be able to claim those if this is all in a taxable account. If it is not a taxable account, a retirement account of some sort, you won't be able to get those foreign taxes back, but you also won't pay income tax. So yes, they will become qualified. It'll be similar to DIVO. That's my gun to the head opinion. So should I invest?
Investors? Possibly you!
I think DIVO and IDVO are both great options for me because it kind of follows the pattern that I like to use in my own personal investing. That is, I buy a basket of stocks or I sell puts to pick up shares when I think it's a good value. And as I pick up shares, I sit on those shares. I like to think of myself as a long-term investor. And then over time, if I think something becomes overvalued, it doesn't mean I don't like the stock anymore. But at that point, I might sell a covered call to add a little bit of income and kind of take the edge off of my investment style as well. So if I sell out of the money calls, I feel like I can pick up some income. And if it goes past my strike price and I have to buy to close that and keep my shares, well, then I take the punishment. But, it kind of takes the edge off of what I'm doing. So it works out really well for me. And that's kind of my investment strategy. So IDVO and DIVO kind of do that same thing, and I kind of like that. So yes, I probably will be investing in IDVO, but like I said, I don't have any shares yet, but I imagine that I will be adding in the future. Now, if you have any questions on any of this, please ask down below. I really appreciate you watching. Please like and subscribe if you like any of this information, and we'll see you next time. Have a great night. Whoop.